Have you ever felt this way when you realize that everyone has followed a set of rules for decades, and then suddenly no one believes them anymore? That is where our gold is now. Some large-scale things have just happened in the gold market, and I am talking about a reasonable large scale. Last month, France's central bank withdrew 13 billion euros, $15.1 billion, of gold from under the Federal Reserve Building in New York. There was no news conference. Don't make a fuss. Between July and January, only the 26th of September air-rate transactions fundamentally changed the view of the world's richest institutions on foreign exchange reserves. But France is only the beginning. Germany, Poland, India, Turkey, and Serbia are all doing the same. Central banks around the world are engaged in what can only be called a coordinated, silent monetary revolution. If you hold gold, understand the financial system, or care where your wealth is, you need to understand what is happening now. This is not speculation or conspiracy theory. Real money is flowing. Real jurisdiction is changing. For the first time since the end of the Cold War, genuine institutional mistrust has been integrated into the global financial system. So what happened? How did the central bank move billions of dollars without notice? Let's break it down. Imagine yourself the governor of the French central bank. It is July 2025. Gold hit a record high of nearly $5,600 an ounce. A vault beneath a Federal Reserve Building in Manhattan holds 129 tons of gold. That gold is out of date. This is not standard, not in line with current international trade norms. No one is forcing you to move. The Fed remains technically safe. Strictly speaking, this is a sovereign territory of the United States. Since the establishment of the post-war system in 1945, it has been a place for central banks to reserve gold. So, why move? The French did a very clever thing. They did not actually repatriate gold. No ships, no diplomatic incidents, no headlines. Instead, they engaged in what financial analysts call high-quality arbitrage. Here is how it works. The Central Bank of France sold 129 tons of old non-standard ingots at record prices in New York while buying the modern London commodity delivery belt equivalent to the international standard for gold trading in the European market. The new bar entered the vaults of Paris. All gold remained unchanged, but the quality improved and the location changed. What about profits? 12.8 billion euros. This figure will be subdivided into 11 billion yuan in 2025 and an additional 1.8 billion yuan in capital gains through single currency operation in 2026. Looking ahead, Bank of France's annual net profit in 2025 is 8.1 billion euros. The move increased normal operating profit for nearly 2 years. They turned their reserves into income-generating machines. The highlight of this campaign is, what is really strategic is how it is publicly positioned. The governor, François Villeroy de Galhau, said the move was not politically motivated. He explained that French gold needed to meet modern trade standards. European markets make it easier than refining existing stocks. This is technical. This is bureaucracy. Boring. But it is not boring at all. Everyone knows that is not the case. When you look at what is actually happening, you'll see one of the world's largest central banks make a statement with its own actions. We'd rather be in Paris than in New York. The message was answered. Central banks around the world are listening. The central bank's transfer of gold is nothing new. This often happens. Unprecedented since the end of the Cold War has been the scale, speed, and coordination of what is happening now. Let's start with historical context. As early as 1965, de Gaulle was deeply suspicious of what he called excessive dollar privilege. The system allows the United States to print reserve currencies, while other countries must abide by the dollar rules. De Gaulle rejected the arrangement. He did something radical for that era. He sent a warship, actually a warship, to New York to retrieve French gold. He traded dollars for physical gold. It was a direct political challenge to the dollar's dominance, effectively exacerbating instability that led Richard Nixon to close the Golden Window and end the Bretton Woods system in 1971. 60 years later, France did it again. There were no warships this time. No headlines. There is no political stage. Silent financial engineering has achieved the same goal of getting gold out of U.S. jurisdictions. But what is really striking is that France is not alone, or even much more. The World Gold Council's 2025 survey of central bank gold reserves is based on responses from 73 institutions, about 95% of the world's central bank reserves. And some unusual things are unfolding. 59% of central banks now store at least some of their gold domestically, up from 41% in 2024. That is 18 percentage points a year. This represents the biggest shift in the gold storage model in nearly 5 years. And the whole action has taken place only in the past 12 months. The World Gold Council also found that 95% of respondents expected global central bank gold reserves to rise next year. This is the nearly unanimous bullish stance of the monetary authorities. This coordination is no accident. The scales illustrate that. Central banks have brought back about 6,900 tons of gold since 1972, according to the World Gold Council. Almost all of these movements have taken place in the past 5 years, most of them in the past 2 years. In terms of size, 6,900 tons, about the sum of all gold from global banks, are going home in one direction. Everyone pointed to a specific time point as a catalyst, February 2022. Russia's foreign exchange reserves of about $300 billion in cash and securities have been frozen by Western sanctions. This has changed the central bank's overall thinking on the location of assets. When a $300 billion reserve account is locked in, it is clear that location matters more than the name on the account. Entity counterparty risk replaces jurisdiction risk at the level of financial issues. The central bank noticed. They learned. The latest Invesco survey in 2025 found that the central bank's share of domestic gold reserves increased by 18 percentage points, almost entirely in line with the timing of Russian sanctions. It is no coincidence. It was a learning moment that became an institutional response. Who is moving gold? India repatriated about 280 tons in 4 years, most of them from the Bank of England in 2024. Serbia returned all of its roughly $6 billion worth of gold to its domestic coffers in July 2025, explicitly avoiding traditional trusteeship centers such as New York or London. Poland became a prominent buyer and returnee in 2025, with domestic reserves increasing by more than 80 tons. Turkey has been quietly accumulating and buying gold at home for years. Nigeria has begun efforts to return gold. These are not small peripheral financial players. We are talking about major developed economies, emerging market powers, and major trading nations. Consensus is emerging. If you want to understand how serious this is, Germany offers key examples. The situation at the Bundesbank is a tipping point that could change everything. Germany has the world's second largest gold reserve, about 3,378 tons. Among them, the Federal Reserve Bank of New York still has about 1,236 tons of gold, accounting for 36.6% of the total gold reserves in Manhattan, Germany. In terms of background, the New York Fed has about 6,331 tons of foreign gold. Germany alone accounts for nearly 20% of all foreign sovereign gold held by the Federal Reserve. Germany repatriated 674 tons from New York and Paris from 2013 to 2017, when it was classified as routine modernization. The remaining 1,236 tons were clearly determined to be safe to place. That is the consensus. It was a comfort. That is trust. Now fast forward to 2026. Emanuel Minchach, a former senior German central bank official, said publicly in January that it was dangerous to store so much gold in the U.S. given current geopolitical risks. He suggested that the Bundesbank consider further repatriation to strengthen strategic independence. What is important here is that his views are not marginalized, but spread across Germany's political spectrum. AfD calls, Greens calls, FDP. Calls are becoming a political consensus. At the same time, the Bundesbank maintained its official position that New York was still considered a safe and reliable storage site and had no repatriation plans. There is a gap between the agency's rhetoric and its political demands. The gap is widening. If Germany ships half of its 1236 tons of gold back from New York, you will see a massive disruption in the physical gold market. Gold needs to be purchased, refined to current international standards, and transported. This has created real demand pressures on gold refineries, logistics, and LBMA trading systems without increasing the central bank's total holdings. Market participants are now looking at political developments in Germany because they know what will happen next. Goldman Sachs, JP Morgan, and UBS are all forecasting higher gold prices, but their models do not adequately explain the damage that large-scale repatriation to Germany would actually cause. Let's be honest about what happens below the surface. It is not just about vaults. This is about the basic trust structure that has underpinned the entire global financial system since 1945. After World War II, the victorious countries established a system in which the dollar was pegged to gold and other currencies were pegged to the dollar. Gold flows to New York and the dollar flows out. For 75 years, the Fed has been the world's de facto central bank. Central banks deposit gold in New York as they do in local banks. It is safe. It is liquid. They see it as politically neutral. The system is built on 3 pillars. The first pillar is liquidity. The ability to quickly sell or pledge gold in the world's largest and deepest gold market. The New York Fed's coffers could be tapped. LBMA market may absorb large gold transactions. It is liquid. The second pillar is the network effect. LBMA and the New York Fed gold market handle large-scale trading. Refineries, distributors, and banks clustered around the centers. If you own gold, you want it to be where the market is. The third pillar is political trust. It is almost impossible for the United States to weaponize its internment role. The United States has lost too much. The entire global reserve system depends on that trust. Each column cracked. The liquidity pillar remained largely unchanged, with LBMA still processing about $30 billion in gold transactions a day. But there is a subtle shift. Europe's gold infrastructure has improved significantly. You can now buy and sell major gold positions in London, Switzerland, and Paris with minimal friction. The monopoly effect of New York holdings has faded. The same goes for network effects. European gold refineries can now produce London-quality conveyor rods that meet international standards. You don't have to cross New York anymore. LBMA has been decentralized. European centers such as France and Switzerland can handle large gold businesses independently. The pillar of political trust is the pillar of rupture. It went bankrupt in 2022. Western sanctions against Russia show that the United States is willing to freeze assets, confiscate accounts, and weaponize trusteeship arrangements when it chooses. The current administration in Washington has openly pursued a transactional foreign policy and actively used leverage. Central banks are not stupid. They're watching this. They are reacting. What they said was simple. We can no longer rely on political trust, so we replace it with judicial autonomy. We're bringing gold home. That is why it is so big, and that is the data most people can't connect to. For the first time since the Bretton Woods system was established, global central banks hold more gold than treasury bonds. According to data from the World Gold Council at the beginning of 2026, the central bank's gold reserves are about $4 trillion, while the central bank holds about $3.9 trillion in U.S. Treasury bonds. It was a turning point. This is a major shift in the way central banks around the world consider storing wealth. It is not that the central bank suddenly invested in gold instead of treasury bonds. Instead, they are reassessing their reserve preferences. Gold is now the preferred safe haven asset, not the dollar or treasury bonds. The trend is hard to see in official data. It didn't make headlines. It slowly priced through quiet central bank operations and discrete financial projects, such as those just implemented in France. But it is true. It is accelerating. The market has not yet fully priced. How can the central bank actually move billions of gold without disrupting markets or triggering panic? French companies provide us with a template. Instead of dramatic actual repatriation, which would require the potential market impact of maritime logistics, security agreements, physical mobility, and political optics, they have taken more subtle actions. They use market opportunities and paper deals to move entities without any disruption. When gold prices are at record levels, the incentive structure changes fundamentally. Older non-standard gold that does not meet current trading norms suddenly has a very different book value from market prices. This gap becomes an arbitrage opportunity. France takes advantage of the record gold price of nearly $5,600 an ounce in January 2026. The spread between the old format and the new London Good Delivery Standard Gold, the European deep gold market, which can absorb 129 tons of supply without disrupting prices, and accounting opportunities for mark-to-market gains to offset operating losses. By executing the 26th of September air rate transactions over 6 months, they spread their activities over time. No deal is big enough to affect prices. No model will attract market analysis or attention. There is a key missing point in the market model. When central banks send back gold, they do not increase global gold supply. They're moving, but moving creates friction in the system. When you move 129 tons of gold from New York to Paris, the 129 tons are no longer available for immediate LBMA lending and trading. The available supply in the real market has declined, although the global supply has not changed at all. Borrowing costs have risen as supply channels have dwindled. The gold rental rate increases the cost of borrowing gold in the short term. This creates a premium for instant physical gold over paper gold contracts. Most investors don't see that. Market models often ignore this. But over time, the real demand pressure is reflected in gold prices. Now imagine if Germany moved 1236 tons. That is about 10 times as much as in France. Depending on the scale, the mechanism will be completely different. They may not be able to absorb the deal through quiet arbitrage. They need physical transportation. This will create huge supply pressures. That will push up rents. That will almost certainly affect gold prices. That is why market participants are now paying so careful attention to German political developments. Investment banks have sharply raised their expectations for gold prices. And when you look at their reasoning, they almost always return to the behavior of the central bank. Driven by demand from emerging market central banks, Goldman Sachs raised its gold price forecast for 2026 to 2027 to $4,000 to $5,400 an ounce. One of the world's largest investment banks is building a $1,400 range, mainly around central bank purchases, rather than traditional supply and demand dynamics, inflation indicators, and even Federal Reserve policy. This is the accumulation and return of the central bank. JP Morgan Chase Private Bank expects $6,000 to $6,300 an ounce, explicitly linking earnings to diversification away from the dollar. They are forming a direct link. The central bank's shift from the dollar to gold equals a rise in gold prices. This is not theoretical. This is their basic case forecast. UBS target is $4,200, citing reduced global dollar exposure. The same view is that de-dollarization equals gold appreciation. The spread between these forecasts, $3,100 to $6,300, reflects real uncertainty about the pace of the central bank's repatriation, not differences in direction. Major banks believe gold prices are higher. The only debate is how big and fast. This represents a fundamental shift in the way the largest financial institutions model gold. Historically, gold prices have been driven by interest rates, the dollar index, and inflation expectations. Sophisticated investors have sophisticated models that balance these factors. But relations between the two countries have deteriorated sharply since 2022. When the Fed raises interest rates, gold should fall, but it will continue to rise. When the dollar strengthens, gold should fall, but it is still rising. The relevance of these traditions has collapsed. Why? Because the central bank has become a price-insensitive source of demand. They don't buy or sell based on yield calculations. They buy based on geopolitical risks and currency diversification. This creates new demand dynamics that the old model cannot capture. That is why Goldman Sachs, JP Morgan Chase, and UBS predict that gold prices will be much higher than what appeared reasonable before 2022. The way gold prices are set has changed, but most models have not kept up. Here is what most people lack. Yes, gold is likely to rise, and most smart money agree. But something deeper is happening, affecting the structure of the global financial system itself. For 75 years, the United States was considered the safest place to store wealth. Your gold is safer in New York than in your own country. Your dollar is safer than your own currency. Behind it is the American financial system. That consensus is ending. Not everywhere, not at the same time, but it is ending. When two European central banks, France and Germany, openly question whether their gold should remain in American vaults, you see a crisis of legitimacy in the post-war order. It is not dramatic. This is not revolutionary, but it is true. My expectation is that gold prices will rise in the next 2 or 3 years, but not in a straight line. You will see upward pressure on central bank demand. You will see resistance to interest rate hikes and a stronger dollar. You'll see the destruction of geopolitical events like the Middle East conflict, which have just pushed gold prices down 15 to 20% from their January highs. Central bank buying does not mean steady appreciation. This means that the lower price limit is raised. When gold falls, the central bank will support it. When gold rebounded, geopolitical concerns pushed it higher. The scope expanded. For those who hold physical gold or gold ETFs, it is important that you don't hold just one commodity. You're hedging against currency instability and currency devaluation. The actions of major central banks are making such hedges increasingly valuable. The traditional advice is to hold 5 to 10% of gold because the insurance industry looks smarter than it was 5 years ago. This is how the most important institutions in financial markets now price. The biggest risk that has not yet been priced by the market is what happens if a major developed country repatriates gold entirely from the United States, with a range of consequences. If Germany moves 1236 tons, will it trigger Italy to move? Will it trigger Japan? Will it trigger Switzerland? At some point, the cyber effect of keeping gold in New York collapsed. The overall structure of gold trusteeship and LBMA system needs to be reorganized. This is tail risk, with a probability of 10 to 15%. But if it does happen, the disruption in the physical supply of gold could be unusual. The surface story here is interesting. Central banks are quietly moving gold from New York to their vaults. France made 13 billion euros, and Germany may follow suit. Gold prices could rise. The deeper story is about trust, sovereignty, and declining confidence in the dollar-based system. When the world's safest institutions no longer trust the world's safest places to protect their wealth, you will see a fundamental shift in the way the global financial system works. That shift is happening. Things are happening quietly. There were no headlines. But if you know where to look, evidence is everywhere. The central bank is moving billions of gold, not thousands, hundreds of millions, but billions. They did so with a purpose. The question is not whether that matters. Yes. The question is how quickly the market will price it, and my guess is that we may be in the early stages of a bigger move. If you hold gold, that confirms your point. If you think about it, the next few years may be the most important window into these developments and their location. Be vigilant. Follow the money. Focus on what central banks are actually doing, not what they are saying. That is the real signal.